today, it's all happening again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. And I'm pleased to say that Tarric is back for another conversation. Hi, Tarric. How are you doing?
G'day. Oh, I'm pretty good, mate. How are you?
Yeah, I'm pretty good. It's a little cold over here at the moment. We've had flurries of snow, and they're talking about a lot more snow next week as the cold weather and the warm weather collides sort of over southern England. So we'll see about that. But I do confess that I think I prefer the cooler weather rather than the stuff you've got at the moment down there in Sydney.
Yeah, it's quite a warm day today. Nice and humid for those who like it. But boy, it's only been 3 weeks since we had our last chat, and so much has changed and so much has transpired. I mean, even just in the last 24 hours with what we've seen with the US and British military strikes on Houthi targets in Yemen.
Yes, lots of things we need to talk about. And I suppose the first observation, Tarric, is that I remember the end of last year, people were talking about, well, 2024 looks like it's going to be a much better year. Inflation's beat and, et cetera, et cetera. But it, it feels to me as though it's all continuing, right? And it's getting more complex, and we've got these proxy wars popping up in various places and getting more complicated. We've got container prices rising significantly. We've got concerns about LNG supplies because of the fact they have to go around Africa now. If you look at what's going on politically in the US, if you look at what's happening locally in Australia, the Greens sort of talking about shaking up some of the housing policy again. I mean, it's like, are we sure we're in 2024? Is it a replay of 2023 by mistake?
It certainly does feel like that. But I mean, I guess that in some ways that this year is going to be, just inherently different, as you say, because of the US presidential election and, all the fun and games that's going to bring. Because, I think that one of the interesting differences between the US and basically most other nations is that their election cycles aren't, the 6-week campaigns that we are accustomed to here in Australia, roughly 6 weeks, give or take. They're going to have the primary process, and all that starts now, so that's going to be quite interesting. But I think that it's also just really just early to be talking about how inflation is beat and how it's all going to be, hunky dory and stuff. And it's just all a little bit premature for me. And I think the thing is, you look at, say like indicators, so like US wages growth reaccelerating and stuff like that. And I just look at it and go, okay, are rents really going to stay at, 0 or 1% or 1.5% year on year when wages are growing at 5%? I don't think so. Not over the long term anyway.
Well, it's clear, and it's been a long-term relationship, that the trajectory of rents is more aligned to incomes than it is to house prices, right? And that's a long-term trend, and it's not just in Australia. That's true in the US and other places too. So as you say, if the wages trends continue to trend up, then rents are going to trend up. And I think about a third of the US inflation was actually in that sector of the economy. So this is a big factor. I think the other interesting observation, and the markets got really, really heated at the end of last year because they were interpreting what Jerome Powell was saying as pretty dovish with regard to rates. So they've priced in six hikes, I think it's in this year. The Fed dot plot never said 6; they only said sort of 3-ish, but it's probably going to be later in the year rather than sooner with some of the new data that's coming through. Comparatively in Australia, of course, we're a long way behind that curve. So we never put rates up as high. Wages growth is not as strong. There's a bunch of factors in Australia that suggest that the RBA is unlikely to be able to take rates lower anytime soon. And actually, I was reading the other day, some people are still suggesting they might have to put the rates up a little higher in Australia. So this is going to play out not over a few months, but over the year plus. And then we've got some of those externalities. The price of oil may be down a bit, although it jumped quite a lot yesterday after that intervention in the Middle East. But we've got other factors that are still showing that services inflation is quite strong. And I do come back to the shipping question. The price of containers going up again. And of course, guess what? That is resonant of the last inflation sort of surge that we saw was driven partly by goods. I noticed that Tesla, for example, has now stopped production in Germany for a couple of weeks because they can't get the parts. So already it's hitting some of those big organizations. So I think that there's a lot to play for, and like I said, a lot to play through the year. I come back to the other point, of course, the US election. It's going to be crazy this year because of the way that the election cycle is working. And of course, around the world, we've got a lot of elections in a lot of countries. So interesting year ahead, I think.
The US is going to be an interesting one because there are a lot of people acting like it's going to be the last election ever. Now, I personally don't buy that Trump's going to make himself Julius Caesar or whatever else people are going on about. I don't see it. And even in some crazy world, if he were to try that, there's a little thing called other arms of the government and the military who are sworn to uphold the Constitution. So yeah, I don't really see that happening. But by the same token, it doesn't matter what I believe or what you believe or what we think. It's what other people believe, what these people, and what they're going to sort of, the way they're going to fight, this election, basically, to the death, so to speak, in terms of just how high they see these particular stakes. And I think that election and that backdrop is going to be something that's going to heavily influence policy, and it's going to heavily influence the outcome of this year. Because, for example, one of the reasons why we're seeing what we're seeing in the Middle East is because the US is perceived as insufficiently assertive, shall we say. I wouldn't go as far as weak. Perhaps in some quarters they are, but let's just say insufficiently assertive. Because they've screwed up the diplomatic response. They couldn't even get Australia on side to send a warship. And they couldn't even put together a coalition of, or even just ring up NATO and say, hey, it's our job to do X, Y, and Z. Maybe we should protect civilian shipping. And I don't know the reasons as to why they didn't do that, but they didn't. Or use any number of other diplomatic apparatuses to secure support in order to make this solely about civilian shipping and solely about, preventing inflation and all these other issues, because it's going to be an issue for Korea, Japan, you name it, everybody, if this is allowed to continue long term. Yet they've completely stuffed it up. And that, I think, is going to invite further action on the part of America's rivals. Now, whether or not they actually are pulling the trigger is another matter, but the incentive is there. And if you're America's rival, why wouldn't you keep making them look like idiots or giving them opportunity to make themselves look like idiots?
I think that's a very good point. And interestingly, I was listening to a couple of ex-senior military people from the US who are tearing their hair out, saying they've lost the plot. Politically, they've lost the plot. They're not actually able to do the things that you would expect them to be doing. And so there's almost a political reluctance to do some of the things. And whether that's because people are thinking about, the way that Trump was thinking in the previous administration and whether that's playing into it, I'm not sure. But it does seem to me that the question of what the US is doing and what it's wanting to do is a really big one. And you're dead right. There are a lot of other players around the world looking at the apparent, quote, reluctance and weakness of the US and thinking, oh, here's an opportunity then. Let's push them a bit further and see whether we can get the elastic to snap.
Yeah, basically, yeah. And I think that's just going to be a theme, throughout the year. And I think as well is that it's a limited time only, sort of offer, because if they are going to end up potentially with Trump back in the White House at the start of next year, when the next presidential term begins in January, their options are going to be far more limited if Trump is going to once again take the sort of Kissinger, Richard Nixon approach of, you don't know what I'm going to do, but it could be crazy, it could be big. And that sort of, I'm going to wave this big stick around and, God knows what's going to happen if you guys get in the way. I think that sort of incentivizes people to act before we get to that point. So that makes, to me, the next 12 months that opportunity, that if you're going to act, if you have the means to act in the sort of short to medium term, the incentive is to do it now, before you end up with someone like Trump or Nikki Haley or whoever who may end up being a lot less reluctant about waving the big stick around and sending the carriers off to do whatever they believe they need to do.
Well, I guess the other point there is that Trump, of course, was not very positive towards NATO in the last time around. So then the question is, well, will the US pull their horns back in and say, well, unless it actually directly impacts us, why would we do things? So, this could go one of two ways, it seems to me.
Yeah, I think it's going to really depend on the sort of theater or the area in question, because, Trump has expressed, as far as he's concerned, there should be peace in Ukraine. And he doesn't really, from what I've seen, he's not really too concerned how that's achieved. He says, I can achieve peace in 24 hours in Ukraine. And I think that there would be people who would be unhappy about how he would achieve that peace in 24 hours and the concessions that would have to be made to the Russians to achieve that. But then by the same token, I think that when you look at something, say, like the Red Sea issue, I think that Trump that would have been a lot more aggressive in addressing this, both diplomatically and militarily, than the Biden administration has, because it directly impacts America. Because if this does go on, it's only a matter of time until you start seeing US companies with supply chain issues, having issues with inflation. And I think that's going to be a problem for Biden as well, because if he is seen as weak and it starts impacting US consumers, then that's going to be a much, much greater problem for him. And I think that ironically, on the other side of the coin, that's why he's been somewhat reluctant to pull the trigger, because he doesn't want to create another war in the Middle East that could put upward pressure on oil. So it's really a bit of a catch-22 from a geopolitical and political perspective for the Biden administration.
No, I agree with that. And the final observation before we get into the charts is that, of course, the US has now increased the production of oil and LNG. I think they're right up there now. I believe that they've overtaken Australia in terms of the exports of LNG. So there's also another factor in the mix, which is what is the energy policy in the US doing and how that's actually playing in as well, because that might change some of the imperatives too.
Indeed. I mean, that's actually an interesting one, because, for a while there, Australia was vying with Qatar as the world's largest exporter of LNG. We sort of jostled and swapped spots for a few years there. But now the US is absolutely streaking ahead in terms of its LNG exports. So that could have an impact on Australia in time, because it means that if the market does get to the point where it is oversupplied in the short term, then that could put downward pressure on gas prices, which in some ways is a good thing, would be a positive thing for Australian consumers if it gets passed on. But then on the other hand, it means lower levels of revenue and all the things that come with it, especially as well, because we've got to a point now where LNG is very much a factor, a massive factor, in fact, underpinning Australia's trade surplus and our current account surplus. And if you take that away, well, that could put some extra pressure on the Australian dollar and the federal budget.
Spot on. And of course, the marginal cost of the gas, because the international gas prices are very basically translated into electricity costs in Australia. So if they actually stay high or go higher because of the disruption, that will have a negative impact in terms of the cost of energy in Australia. East Coast, especially. I have to say that the whole LNG thing in the Australian context has been badly mismanaged for at least 20 years, and I'm afraid we're reaping the whirlwind on that.
We are, and we will continue to. And I think that that's going to be an interesting one when we get to sort of around about July, when we see the rejigging of wholesale electricity, basically when electricity prices are altered and you see what the new retail rates are for consumers. And I think that could be something that could be really interesting if we do see continued shipping disruptions, or if, for example, say for example, we don't get the rain that's expected in, say, Panama, which is a main thoroughfare for LNG exports and imports throughout the world. So it's going to be an interesting one in that regard, because that snapshot that we get mid-year is going to decide what electricity price inflation is going to do in Australia in broad terms between July 2024 and June 2025, which could be quite key to inflation and what the RBA has in terms of justification to cut rates down the road.
Yeah, and just on that, of course, the inflation numbers that came out were a little down from where they were previously, but the energy costs and, in fact, the rent costs in terms of inflation as reported were lower than in reality because of government intervention, right? And I guess the question is, how much longer will that government intervention go on for? And, if the inflation number is bigger, but it's being optically squeezed by government policy, how does that play into what the RBA does?
Indeed, and I think that is part of what makes the energy price reset later in the year so interesting, because most of the impact on consumers has actually been blunted by the subsidies. If not, electricity price inflation would be significantly higher than it is now. So the conclusion of those subsidies and this big reset is going to be quite an interesting one, because it's about how all these different factors end up balancing out in the end. So it's going to be a really, really interesting one, because there's also, on the other side of things, there's also the capex on renewables, the capex on transmission lines, all of which is going to add to the cost of transmission, which feeds into all of our electricity bills.
Absolutely. Well, we better get on and look at the charts, otherwise we never will. And I have to say that this was hilarious. The only thing I would add to it is that it should be mission accomplished ?
Yeah, well, that would be more factually correct than the little meme we've got going here.
Yeah, but fantastic.
Yeah. No, it's a good one, because I think that perhaps not most, but a sizable proportion of analysts and economists think that Powell's made a bit of a mistake by taking the tone a little bit too dovish too early. But we'll have to see. As always, people, the charts are available at avidcom.substack.com, and we'll get right into the charts, people. Okay, now, what I've done here is put together a bunch of different scenarios on what housing-related inflation could do in Australia. Now, this is only for new homes and rents. There are other housing components, but we're just going to be focusing on those two for today. Basically, what we've got is a range of new home price inflation and a range of rents across the board. So from 10% rents and 4% new home inflation to 14% rents, 6% new home inflation. Now, currently rental inflation is 7.1%, but as Martin mentioned, that is artificially suppressed by government subsidies which through the outside increase in rent assistance. And new home price inflation has re-accelerated to 5.5% year on year. Now, with construction wages rising at one of the fastest rates of any industry, we could continue to see upward pressure even as the sort of pipeline of homes starts to fall away. So that's going to be a really interesting one going forward, especially some people in the industry have also mentioned that changes to building codes and to energy efficiency levels is also going to put a degree of upward pressure on new homes. But suffice to say that even some of these sort of more mid-range scenarios are still seeing these two CPI components that make up less than 15% of the CPI basket, contributing more than 1% to headline inflation by themselves.
And that's a big deal, isn't it? Because the latest from PropTrack showed that the rental growth is still very strong, not uniformly strong, but particularly units was really strong. And I'm not sure that this inflation factor is fully comprehended by a lot of people who are talking about the fact that inflation is coming down. And it's the same in the US, of course. This sector of the inflation dial seems to be much stronger than expected. And I guess it's partly driven by the lack of supply and significant demand.
Indeed, and part of the issue is that our lag is greater than the US. Like, we are lagging by somewhere between around about 15 to 18 months. And obviously, unlike the US, where when rental growth has moderated significantly, and in some instances even potentially reversed, even though it's resurgent now. For Australia, we're still seeing the snapshot we see in the CPI today is what happened 15 or 18 months ago. So we haven't even seen that initial peak in rents, let alone the second peak in rents that is now being seen by people in the data of people, say, like Domain, which has seen sort of a little bit of a double top going on in rents over time. And they're saying, they saw rental price growth at a capital city level, which is what is measured in the CPI, top out around 14%. Now, SQM saw it at above 20. Personally, I think we're probably going to end up seeing around about 12, just due to the ABS methodology. But I mean, low said about 10-ish. So, 10, 12, regardless, it's going to be high, and it's going to be high for a very long time. And that's going to be a bit of a thorn in the side going forward, I think.
Yeah. And the other point there is the new construction costs are likely to be higher, and the shipping disruptions that we chatted about earlier on will flow forward into high material costs. And I was talking to somebody in the construction industry the other day who was saying he is still having to pay significantly higher wages just to get people to work on his projects. So you've still got upward pressures both from materials and from wages in the construction industry, which suggests that the new cost of new homes are also likely to continue to rise. So like I say, this is a really important sector. This is going to drive inflation much further and much longer than people think.
I think that's something that sort of just needs to be considered and assessed. And this is something that I'm yet to find sort of super meaningful data on. But what I want to know is, to what degree are home renovations impacting this? Now, I know that there's like the finance data for home renovations, but it's not perfect, because, there's obviously the issues with inflation and measuring the differences in it over time, which isn't exactly perfect in that regard. But I would just wonder, to what degree are people just, instead of moving because of the high cost of housing and because of the high cost of stamp duty, etc., the high transaction costs, are people turning to tradies to come renovate their homes instead? And is that potentially impacting the demand for labor and thereby new home price inflation?
Good question. And it's one that I actually put into my surveys at the beginning of this year, because I started to realize, as I was watching the data, that we are seeing a change in the weather. So people who were thinking particularly of down trading or up trading, in other words, changing property, maybe they're not now, and maybe what they're doing is making changes to the existing property they've got. So in a month or two, I'll have sufficient data coming through from my surveys to understand whether there's been a change in the weather there. And if there has, that could be a big deal.
100%. That's fantastic. I'm really, really looking forward to that, because
I'll share that.
Excellent. Thank you. No, because that could really put a fly in the ointment in a lot of different ways. It could put upward pressure on inflation, as we just discussed, but it could also further kill housing turnover and new listing volumes. So, well, that would be bad.
I've made it into a compounding question, because basically what I've said is, have you thought about, or are you intending to list? If yes, if no, but then have you also intended to, but then decide not to and done something else? Is basically what I'm trying to get at. And what is that something else? Is it getting a tenant in? Is it doing renovations? What are the other strategies that you might, because it's just too hard to to shift at the moment. So we'll see. I mean, the data could be nothing, but we'll know in a month or two.
No, I'm really curious to see, because another one that I'm really curious about as well is older people renovating their homes or building granny flats on their existing properties for their adult children. Because the more and more I hear about it, the more and more I hear about these renovations being done on, these properties owned by older demographics, so people can have separate living arrangements but still live under the same roof. So, considering that how challenging things are with the rental crisis, with how difficult it is to buy a home. That seems to be an increasingly prevalent trend.
Spot on. Kiddie flats rather than granny flats, right?
Perfect. Love it.
So again, that's part of the compound question that I've got. So I'm trying to sort of understand what this new dynamic is, because I think there is a new dynamic, right? But what it does tell me is, if it's anything like what I think it is, the supply of property coming on the market for sale will continue to be very depressed.
That's going to be an interesting one. Looking forward to it. Okay, now this is what our new home price and rents look like at the moment. Now, as you can see there from the rent, from the line for the rents there, what basically happened was we saw the outsized increase in rent assistance, and that has put downward pressure on rents temporarily. The ABS noted that without the impact of the subsidies, they would be significantly higher, almost 9% at a capital city level. And also, you'll note there that for the back half of 2023 there, we saw new home prices start to roughly plateau in terms of their level of growth, and now they're rising again. And that's something I talked about on Twitter a few months ago, and that is something I think that really should be ringing a few alarm bells in RBA land and in analyst world, because it's going to be quite difficult to get inflation under control with new home prices with a 5 handle and rents with a 10, with a 10 handle. It's going to be quite challenging in that regard, and I think that that's something that's going to be that's something that really just sort of needs to be factored in, because if we are going to continue pressing on with the current conditions, even if we do see a moderation in migration, these issues are going to take years to solve. And I mean, admittedly, we're eventually going to hit a wall in terms of what people are capable of paying, but that takes time.
Just a quick observation. This is, of course, the average across Australia. And in
yes,
fact,
capital city, yes.
There are some significant variations, city by city, right? And I think that's just worth factoring in. So whilst this gives you a sense of what the adjusted average is, the rental subsidies are not spread uniformly across the country. They're actually targeting a particular segment of households. And the new dwelling prices are also not equally spread across the country. So I actually think there's a much more complicated story that this sort of doesn't really get to, because in some areas I would suggest these numbers are way, way higher.
Oh, absolutely. I mean, it's a question of other issues with lag, or particularly in the instance of rents. But yeah, it's going to be interesting to see how it all shakes out in the end, because I think that there's very much a narrative of to full speed ahead, inflation back down to target. But I think that to be complete, this is almost sacrilegious for me to be saying this, but here we go. I actually think that the RBA's inflation forecasts for the next 12 months are actually pretty good. They actually seem, if you actually look at the range of possibilities and what they're seeing, they actually look pretty decent and pretty similar to what some of the different scenarios I put together myself. And it feels weird to say that, because usually the RBA is wrong. So that's putting myself out on a bit of a limb there. But I actually think that if you look at it, they're actually pretty decent, at least for the next 12 months. Beyond that, maybe not so much. But then there's also the issue of the stage 3 tax cuts, because, well, how do you model that?
Well, I think the stage 3 tax cuts is a really, really important question. Again, articles have been written over the last few days saying, well, hang on a moment, that stage 3 tax cut will be inflationary. So therefore, it might actually require the RBA to keep rates higher for longer. Right? And it's just like, how on earth do you model it? But the other factor, of course, is that those tax cuts will only impact a relatively significantly small segment of the population. And a lot of people are still paying way more tax than they were and still are. So, yeah, I think there's a really, really big question. But I agree with you that the RBA's latest view of where inflation is heading for, and it's worth just remembering, folks, that they're talking about 2025 before they come back into band, which would suggest that the rate of rate cut will be quite slow and extended. Now, I'm not saying that they won't start dropping rates until inflation is within band, but they cannot preempt it.
Yeah, I think that the thing is, to me, it comes down to global rates and the Fed. If the Fed fires the starting gun and they start cutting rates, and then I think yes, the RBA will follow suit, because at the end of the day, the RBA is going to say, well, inflation's going in the right direction, it's trending down, it's got a 3 handle, it's not perfect, but it'll do. But I think that the really interesting one is where the US economy holds up better than expected. Rate cuts are harder to justify in the US, so they end up being relatively limited. But here in Australia, we have the issue of obviously more people on variable rate mortgages. So yeah, it's going to be really interesting just to see how it all balances out. Because on one hand, you're going to have more and more people getting pushed to the wall by high rates, but on the other hand, you're going to have other people, generally in the more affluent demographics, pushing in inflation up themselves. So it's going to be really interesting just to see exactly how they can balance those forces out, because you could see a scenario where in more affluent areas things perform relatively well, but in less affluent areas you see economies really start to suffer, you see rising unemployment, and you could see a really, really bad two-speed economy.
Absolutely. And I will make the point that a lot of the mortgage stress are sitting with households who would not benefit from the stage 3 tax cuts.
Well, yeah, exactly. I mean, I think that that's something, that's sort of a little bit underappreciated, just in the sense that, someone on 120K is saving a couple of grand. It's not, I mean, yes, it's a pretty nice windfall. I would be very happy to have an extra couple of $1,000s a year. Thank you very much. But the people at the top end are getting 9,000, not 2,000. Yep. So there's a big difference in that regard in terms of what people are actually getting at the median. Now, it could help speed consumption along quite nicely in aggregate, but as I said, you could just see this very, very wide divergence in outcomes. And it's also worth noting that if you look back through retail sales figures that have been done right down to the granular sub-region level, it wouldn't be the first time this has happened. If you look back to other periods of retail weakness in aggregate, there are times when the affluent parts of, say, the Sydney's eastern suburbs and Sydney's North Shore are still doing very, very well. But if you go out to the mortgage belt, things are a lot more challenging.
Yeah, no, that's exactly right. And that's why, granular analysis is critical here. And again, the surveys that I run are pretty granular, so it gets a really good read as to where people are. And I'd make the final point on this, that the run time, so how long the negative real income growth and the high interest rates bite, is really important, right? Because people can muddle through for a few months. But if in fact that few months drops out to 6 months, 12 months, 18 months, then it gets much, much more challenging. And even, a small tax improvement won't be sufficient to wipe away the pain that they've had over the last 18 months. So there's a cumulative effect, which I'm not sure a lot of people appreciate. And why is it cumulative? Because you go for buy now, pay later, you go for credit cards, you put off purchases, you put off healthcare treatments, or there's things you can put off, but eventually you can't put it off. And even with the banks extend and pretend for mortgage holders, chickens do come home to roost.
Indeed, I think that's probably the key thing about the higher for longer thing in general. It's all about time. Given enough time, will the settings of the economy, will the settings currently being imposed by monetary policy start breaking stuff in the economy? Yeah, they will. But will they be left at that level for long enough? That remains to be seen.
Yeah, that is the big question.
Indeed. Okay, now, housing is a big, big issue politically in Australia recently. And what I've done here is I've taken a very, very simple metric. I have taken the number of dwellings in Australia and divided it the population of Australia, and then divided it by the number of dwellings. Now, as you can see, the ratio has been declining anyway over time, and it was declining quite significantly prior to COVID, and that was due to just changing demographics, older households, single households, empty nesters, etc. And by my estimation, based on dwelling completions and the historic ratio of dwelling completions translating into actual net additions to the dwelling stock, we've actually seen that rise quite significantly over the last 12 months. The ratio is actually rising. So the number of persons per dwelling is rising and rising significantly. And we're actually now quite a little bit above where we would have been had the demographic decline continued and us not had a rental crisis. So I think that this should address the idea that the main driver of the issues that we face with housing at the moment is being driven by people who went out and wanted homes, who left share houses, etc., during the pandemic, and that being one of the major drivers. I think this illustrates quite nicely that that's no longer really the case. It's just purely a case of too many people, not enough houses.
Spot on. And one of the things I see in my survey already is the idea of, people moving back with parents, or parents moving into their kids' houses. So that's one of the reasons why the numbers are going up. It's not that we've got a proliferation of more kids being produced, and therefore, youngsters coming into the count. It's this more consolidation of households. Or another example is somebody decides to let out one of their rooms as another source of income. And I think that's something which we're seeing quite a lot of, again, in the surveys, that people are actually saying, well, I need to find, how do I generate more revenue? I can actually let out a room or two, and I'll take some tenants. And again, that sort of produces a more a greater density in terms of property use. Other point it's worth just highlighting is that the down traders are still quite active. So there's more than 1 million people expected to move from their current property to a smaller property. But if in fact, going back to my earlier point, if in fact they are unable or unwilling to transact because they can't get the price that they want, the other option is then to say, well, okay, I'll stay where I am, but what I'll do is to do some conversion work, and I'll actually create a couple of extra, separate living areas, and I can let those out. So I suspect that's part of this story as well.
No, I concur. And that just makes it all the more interesting in terms of looking at your data when it does come to fruition in a few months' time.
Yep.
Okay, now this one's admittedly a bit outdated, but unfortunately it was the latest data that I could find, or latest government data I could find, I should say. But basically, it just shows that roughly 2/3 of all Australian household wealth on an average basis stems from the principal place of residence or property investments. So I also just think it's worth noting that this doesn't count property that is purchased through trusts, and it doesn't count property interests that are held in super. Purely property that is held in the name of individuals. So I think that's a bit of an interesting one, because it's not quite like that in a lot of other places.
That's putting it politely. And it's just worth reflecting on the relativities, right? It's more than $10 trillion worth of property related assets. Superannuation is what, 3 and a bit trillion. So you can see the relativities, right? Property is it. And, I always come back to this. Australia is about houses and holes. Here's another example. But it also suggests that if property prices were to slide, then the wealth destruction that would be created would be ginormous.
Yeah. And I think that just illustrates why policymakers are so terrified of that. They're terrified that if it were to occur, that the reverse wealth effect would take a wrecking ball to things. And I think that in that perspective is needed. Like recently, I think it wasn't actually recently, it was actually almost a year ago now, but Shane Oliver wrote a really good piece on the issue of negative equity. And now this was at the time of when housing prices were still falling and falling relatively swiftly here in Australia at the start of last year. And he basically came to the conclusion that housing prices could have a GFC-sized fall, a US GFC-sized fall from their peaks, and the proportion of Australian homeowners who would be in negative equity, Australian mortgage holders who'd be in negative equity, would be less than 5%. Now, that compares with something like 20 to 25%, depending on your estimate, in the US during the height of the global financial crisis. And there's a very good reason for that. Basically, it's that housing prices had run up so much that the vast majority of people were sitting on enormous amounts of equity. So we had a very, very unique, or we still have a very, very unique opportunity for property prices to decline, and to decline fairly significantly, particularly considering the fact that wages are growing. And if you have, admittedly, still nowhere near what property prices have risen, but if you have rising wages and falling housing prices, you could actually get to something resembling a bit of a better equilibrium. But that we weren't allowed for that to happen because, that would make a lot of very influential people very unhappy.
It would. And it would also, the distribution of the debt's the problem, right? You still got a proportion of people who would actually be in negative equity, and you don't need a vast proportion to be in negative equity to really have a significant negative economic impact. And of course, the banks will be particularly worried because one of the things that happens is they have to then put more capital against those mortgages, which means that it's a big cost to the banks. And of course, the financial stability risks is the thing that APRA and the RBA are quite concerned about. And if property prices were to ease down, and if some of those negative equity scenarios played out, that could have a profound impact on financial stability more broadly. So, it doesn't have to be as bad as the GFC in terms of the spread. It's still sufficiently worrisome because of the high debt concentration, because we're world leading in terms of real disposable income to debt in Australia. There's nobody else as worse as Australians. So that's the real question. So it does become a question of fight inflation, yes, no. Fight financial stability, yes, no. And how do you actually try and balance those two things? Because there is a balancing going on between those two things.
Yeah, I imagine at this point it's relatively constant. I just wonder how things would have been if we didn't see, migration raise to roughly double what the previous record was prior to the pandemic. I think it really would have been quite interesting just to see how things played out, because I think the thing with property is that because it's, prices are set by the marginal buyer, it is a very subtle balance that goes on between all these different factors. We saw that rising rates, even by the time, even before they got all that high, was still having a significant impact on housing prices. Yet when, migration got raised to such a significant degree, and you saw the rental crisis just blow up and more first home buyers just trying to grab onto whatever they could get their hands on, it really just changed the calculus and just tipped that balance just that little bit. And, we've all seen the result.
Yeah, well, Edwin makes the point, and I think he's right, that if you look at the movement in the pendulum in terms of listings, it doesn't have to move very far one way or the other to really have a significant impact on prices and also on demand. So it is the marginal buyer, and it is quite sensitive. And of course, it's differentially sensitive in different locations. At the moment, if you look at Hobart, for example, in Tasmania, prices have started to fall quite significantly there over the last few months, actually. And so the dynamic in that part of the country is very different from, let's say, Brisbane, where it's gone crazy.
Yeah. And I think, yes, I'm glad this is the next slide. And And I think that this is a good one because if you compare Melbourne and Sydney in terms of the balance of listings, Melbourne is faring one of the worst of, well, it is faring the worst of all the largest capitals. And if you look at the Real Estate Institute of Victoria data, their conclusion is that house prices, not housing, but house prices, never actually stopped falling based on median sale price. So I think that that's a rather interesting one, just to sort of illustrate that point, that it is very much about the balance of the different factors in different markets and just how drastically that can vary between those markets.
No, exactly right. And again, I have to say, sorry, folks, you've heard me say this before. Granularity is critical, right? You have to look at the detail. You can't just look at the aggregate averages across the country or indeed across the city. What's going on in Melbourne at the moment with the very high listings numbers, the significantly easing of house prices is really worth getting to understand, because it seems to me that that market is behaving now quite differently from Sydney. And, the question is Melbourne behaving differently simply because of some externalities, or is it a timing question?
Yeah, and it's going to be interesting to see which one it is.
Yep.
Okay. Now, I posted this the other day and it annoyed a lot of people for some reason. But anyway, it's from The Economist. And what we've got here is 3 columns. The first one is GDP per capita at market rates. The second column is GDP per capita adjusted for purchasing power. And the third column is GDP per capita adjusted for purchasing power, and then also adjusted for the number of hours worked per nation. And it's interesting because in the first one, it looks pretty good. Australia is the 10th highest GDP per capita in the world at current market exchange rates. Pretty good. You start accounting for inflation, we fall down to number 18. You start accounting for the number of hours that Australians work, which in some cases is significantly more than other nations, and we fall out of the top 20 entirely. So I think that in some ways is a nice illustration of just how things are for Australians. We have great GDP. We have great GDP growth. We even may have great GDP growth per capita when you look at it over the long term. But growing LNG exports and growing mining exports are not really serving you and me and the everyday Australian on the street. You might see that filter through somewhat through the federal budget, through greater levels of tax revenue. But in terms of the direct playthrough to the prosperity of the average household, it's not really occurring in the way that it once did.
No, and one of the interesting observations there, you talk about the tax. Well, sure, they are generating some tax, but there's also huge subsidies being paid to a lot of these international corporations, and a lot of the revenue generation is flowing offshore. So the net economic benefit to Australia and Australians is significantly lower than you might first assume based on what we see. And if you look at the way that the ASX works and who the big companies are, and then if you look at the international players like in the LNG sector, a lot of that's just going away from Australia. So this is a really, really important observation. And I keep reminding people that in real terms, the GDP per capita, we've been going backwards for quite some time in Australia. And of course, nobody wants to talk about that. Everybody wants to talk about the top line GDP, which of course is artificially supported, firstly, by the way that we account for education, international education, and secondly, by the very, very high levels of exports, which of course are revenue generating. And with the exchange rates and things where they are, that's something quite positive. So that's why the Australian economy is uniquely positioned. I will put it like that.
Yeah, I agree. I mean, I went through the other day on just exactly how much our large exports bring in, so iron ore, LNG, and coal as a whole. And, you're talking about over 350, at its peak, over $350 billion a year in revenue. And, that's well and truly above what it was previously. And that is playing a major, major role in supporting capital inflows into Australia. admittedly, a lot of it flows back out again, but it is playing a significant role in supporting our currency, which, if you ask some people, is one of the most important things because it helps keep rates lower.
Yes.
And that's what it is all about for some folks.
Spot on. and I have to come back to the lack of diversification in the Australian economy, the lack of manufacturing. It's a very, very unstable pyramid, right? Because the pointy bit, the bit that's actually doing all the heavy work, is very, very narrow. So it has the risk of getting a bit wobbly.
Yeah, and I think the thing is that commodity cycles do happen.
Yep.
Mean reversions in commodity cycles do happen. So if we were to go back to, say, 2016 levels, even if you account for the changes in export volumes, you'd be pulling, well over $100 billion out of the economy relative to where we were at the peak. So what happens to the trade deficit? What happens to the current account, to the strength of the Australian dollar? All of these are questions that are worth asking. And what happens to the federal budget as well, in the longer term? Because it's all well and good, while all this stimulus money and everything else is still sloshing around, and they're taxing people more than any time in decades relative to GDP.
Yeah, well, the tax take is a disgrace. It's so high. And the other point, of course, is that if you think about trade exposure, then you've got to ask, well, what's happening in China? And the latest news on China is not flash. If you look at Fitch doing further downgradings of some of those state entities, and the expectation is that the Chinese government will throw more money at it. But we've also started to see some further cracks in the banking system in China starting to show now as well. So our major exporter is actually a bit worrisome. So again, there's another risk there that could actually play into all of this too.
Indeed. Speaking of risk, basically the US and UK hit at last count when I checked just before the show 14 target. Sorry, it was 60 targets at 14 locations in Yemen. So a fairly sizable, you might call it, a strike on Yemen, but still, in the words of, I believe it was Rishi Sunak or someone in his government, still proportional and limited. Now, I think the problem is that when you're fighting people who are accustomed to fighting people with US weapons and US military intelligence, because the Houthis fought against the Saudi-led coalition for a number of years, they're accustomed to it. And if they're using their brain, which I would have to imagine that people who have gotten used to fighting a war over a number of years they probably would have dispersed all their assets and all the things that they were using anyway. So I think that stopping the attacks using military means without really, just, for want of a better expression, throwing the kitchen sink at it is a pretty challenging task.
Yeah, so they're hoping that the other side will blink, right? But the question is, what if they don't? What do you do next?
Well, exactly, because then, the Houthis have already said, well, we're going to strike back.
Yeah. And
then you just end up in this tit for tat. And at the end of the day, it's not going to get shipping going through the Red Sea all over again. There needs to be either a much larger commitment, to military strikes, or much larger naval commitment to convoy ships through the Red Sea in a way that they would be safe. But each one of those military options carries risks, both, and that brings us back to something we were talking about earlier. It also carries political risk, because you're putting American servicemen and women in danger, which is a political risk in any day of the week, and B, what are the Houthis have a relatively limited level of capability. They're very much a regional level of capability. So what do they do next? If the US continues to escalate, the Houthis will feel like they also need to escalate. So who do they hit? What do they hit next? Do they start doing stuff outside further outside the Red Sea, or do they start hitting US interests in Saudi Arabia as part of the oil infrastructure there, and say, well, we're really sorry, we know we had this little sort of, truce going on, but America, so it's really just in flux in that regard. And I think it's something that's relatively just, uncertain. It's just uncertain, because we just don't know how it's all going to play out.
Mm. Now, the other point, of course, is these huge ships, the big freighters and the big tankers. I mean, they're sitting ducks, aren't they? And given the technology, the drone technology and the the missile technology that's around now, they can be hit from a long, long way back. So it doesn't. So the point is, it's like sort of throwing balls at coconuts in one of those stalls, right? It's pretty straightforward to do.
Yeah, no, I mean, like, that's the thing. I mean, like, I've been doing a little bit of, research into like some of what their inventory looks like.
Yeah.
But you're talking about some of these drones with ranges of, 120, 150 kilometers. And of course, they're suicide drones, so they've only got to go one way. And, they're not much better than not much bigger than a large family dining table. And in terms of the missile inventory, it's nothing that you can't mount on the back of a normal semi-trailer truck. So you can just, have a, whatever Coca-Cola, Pepsi, Lay's, whatever on the side of the truck, like you would see on a highway anywhere in the world, and then pull it back and, hey, presto. Yeah. It's something that's very, very difficult to counter unless you've got the assets in the area constantly ready to just strike at the first sign of trouble. And that takes a fairly sizable commitment. And not only that, but what do you do when they start launching these missiles from near civilian targets?
Yeah.
How willing are people going to be to accept those casualties if the choice to strike is taken? So it's just a mess, really. I think that's the best way of describing it.
Yeah, and just the political backcloth here is there are parties that actually likes disruption, likes uncertainty. I mean, you can see that in the Russian context, you can see it in the Middle East context. And it's almost like you don't need a long-term game plan. All you need to do is just to create more mayhem.
Yeah, well, I mean, exactly. If all you care about is making your opponents look stupid and disrupting them and undermining them, and you can just keep and it doesn't even need to be constant. You can just, a bit here, a bit there. And I mean, it's just basic, asymmetric warfare against a superior opponent.
Spot on.
Just taken from a guerrilla context in the jungle all the way up to, a more regional stage.
Yeah, great.
Okay, now this is a very, very basic thing I put together on how long journeys that were taken directly from Shanghai, which is the world's busiest port, to the busiest ports on the eastern coast of the United States and in Europe. Basically, roughly speaking, on trips to Europe, it is roughly about a 30% increase in duration to Northwest Europe, to the busiest ports. So the likes of Rotterdam, Amsterdam, Hamburg, Antwerp, etc. Now, my estimate was an increase of about 30%. Now, Fitch, the ratings agency, has applied its much, much greater resources than I have to estimate that they believe that total travel time from the Far East to Europe will increase by 50%. Now, they believe that will reduce effective global shipping container capacity by 10 to 15%. Now, we don't have an extra 10 to 15% in shipping capacity. So the question then becomes, who misses out? Who has their supply chains disrupted? Who takes that hit? And where? And, and the thing as well is that there's also that knock-on effect in terms of shipping costs, because if you're the person who doesn't want to have your trade disrupted, who wants to guarantee that you're going to get what you need, you're going to pay more, and you're going to be willing to pay more than your rivals. So it's kind of the potential for a little bit of a feedback loop there if this becomes a long and protracted crisis.
And I like the comment that Fitch said was that we don't expect disruptions to last long enough to have a meaningful impact on global shipping's supply-demand balance in the medium term, right? Which that's all right for Fitch to say that, but actually, now what's happened over the last 24 hours, do you still hold to that? Because, I can't see a short fix in terms of timing to this problem. This has the sense, I think, of something which is just beginning to develop rather than something which is nearly finished. And so if it plays out anything like the last global shipping disruptions, as you say, there aren't enough ships in the right place and aren't enough containers. The price of containers have gone well above 4,000 US now, whereas they were down, between 1,000 and 1,500 last time I looked. That's a big impost. The timing is also very important because it takes a lot longer. And as I said earlier on, Tesla's turned off production in, I think, a German production center simply because they can't get the parts for a couple of weeks. This has a few of the hallmarks, I think, of something which could be very troublesome and inflationary.
Indeed, and I just think it's worth noting that this isn't the first time that conflict has closed the Suez, the Suez Canal in terms of access through the region. It was closed for 8 years between 1967 and 1975.
Yep.
So, and that was also during an inflationary period. Admittedly, that wasn't the only reason, but I'm guessing it probably didn't help. And I just think that this issue is just underappreciated. I think that it's entirely possible that you could somehow see the Israelis, some sort of, say for example, a Qatari sponsored peace agreement between Hamas and Israel, that's supported by some other large actors, maybe a combination of the US and Russia or whoever. Yeah, sure, that could end the conflict in relatively short order, and it's entirely possible. But it's also possible that it won't get ended, and it's also possible that the continued escalation of attacks, both on civilian shipping and on targets in Yemen, could then basically just have the Houthis turn around and go, well, you've hit us hard, so we're going to keep hitting you because, the longer a military campaign goes on, the more people die. And the more bad blood gets created and the more that some people just want to keep the war going regardless.
Yeah, it's muddling through and muddling through without a view of how to actually take it to an endpoint is the problem. And over the last 2 or 3 years, we've seen a number of proxy wars muddling through and people sort of taking sides and doing things, but without clarity as to how they get to the end game. And that is a concern because muddling through means it takes more time, more resources, distracts more people, creates more inflationary pressure, all of those things. And, in the current environment, that's not good.
No, I concur. Okay, now we'll just try and get through these last few slides. Now, this is of Chinese local government bond issuance. And basically, what I just want to illustrate with this chart is that people have been saying, when's the stimulus coming? The stimulus has to come. The stimulus has got to come. The stimulus is the key to all this. Well, the stimulus is in terms of, exactly. In terms of the level of bond issuance, the level of debt issuance, it's already happened.
Yeah.
And if you want to go all the way back to 2019, it's more than doubled in terms of bond issuance. So I think that is one of the really just underappreciated things about the situation in China at the moment. They have to roll over a lot of debts. So, and this is even something that some of the I think it was one of the ratings agencies. I forget who it was. It might have been S&P, but they came out and they basically said that because of the level of debt that needs to be rolled over by local government and local government financing vehicles in 2024, that they believe that despite them throwing cash at it, infrastructure construction growth is actually going to fall. It's still going to, infrastructure building is still going to grow, but it's just not going to grow as quickly. And I think that's going to be a really interesting one going forward because they are trying to be a little bit more responsible with these things, but it's a bit of a game of whack-a-mole for Beijing, I think.
Well, that's right. And the other observation here is that they've taken interest rates down to try and stimulate. They're issuing a lot of bonds, but of course, a lot of international investors are now saying, well, Chinese companies are uninvestable. So in fact, there's an exit of capital from international sources, which I think is probably almost pulling in the other direction. rather than actually what you're seeing here with the Chinese government intervention. So that's why I believe that the story about the Chinese economy is not one of a sudden rebound, a sudden exit from this. We've still got the property valuation problem. We've still got the excess capacity problem. And, looking at it, this is another of those, long-term muddly factors in the global situation.
No, I concur. I think it's going to be something that's going to play out relatively slowly. I think, bar some sort of major catalyst, it's probably going to be something that's just going to be a slow burn over the next few years. Yeah. Naturally, I'll reassess in 12 months and then again in another 12 months, etc. But short term,
I would assess post the Taiwan election.
Well, I was talking economically, but if we want to start including that, then yes, the Taiwan election would be a good one, considering some of the not so veiled threats that have been made by the Chinese government over the last 24 hours.
Yeah.
But yeah, no, I just think that, the say, for example, like degradation of the Chinese real estate sector, that's a story that's going to go on for the next 2, 3, 5 years, maybe even longer, depending on how long they sort of keep these pipelines of projects going.
Yep.
It's something that's going to take a long time to actually reach genuine levels of fundamental demand and not just 85% of investor buy a house.
Yep. Spot on.
Okay. Second last chart. We have seen mortgage applications in the US pick up to a fairly decent degree in recent months because rates have come down, especially since Powell's rather dovish statements put an extra level of downward pressure on bond yields. But looking at this chart, you can kind of see that the recovery so far hasn't been huge. So the US housing market level of turnover remains highly depressed. And it's going to be interesting to see what happens from here, because if turnover levels remain depressed and we do continue to see properties getting listed, because we've started to see what I like to call life happens listings in US property, because people have just held off, and they can't hold off anymore. And we've seen an unseasonable rise in listings when they should be falling. I think that you could start to see some downward pressure on US housing prices in certain markets, because this is very much a different, a granular individual market issue, because there are some parts of the US where housing prices are getting absolutely smashed.
Yep.
And then there's other parts of the US which are seeing high levels of internal migration that are doing quite well, where housing prices are still a little bit more affordable.
Yeah, and again, granularity is critical, particularly in the US market, because as you say, it's so diverse. But the other factor, of course, is you've still got if I'm sitting on a 2% rate mortgage for the next 30 years, then I'm going to be less likely to move. So the ones that actually are moving, as you say, it's a sort of a shit happens moment. You've got to move because you've got no choice but to move. That actually is creating some of the momentum, and it's a bit pent up. So it'll be fascinating to see how this plays out. The mortgage rates have come back a little bit, but they're still much more extended than they were a couple of years ago.
Yeah, they're still historically high, but yeah, it's going to be interesting just to see how the balance goes, because there are demographic factors which do favor, purchases. But then on the other hand, there are also some demographic factors that do favor sales, because there is that cohort of older Americans who are looking to move.
Yep.
And I think it's just worth noting that unlike Australians who tend to generally move locally, I mean, there is obviously, the sort of grey nomad exodus up to Queensland from the southeastern states, but it's nowhere near as prevalent at a society-wide level as it is in the US, where you're seeing something like, one study recently put it at up to 37% of older Americans selling properties moving out of state. That's not really something that we see so much here.
No, although the recent moves to Queensland were dramatic, and that's one of the reasons why prices in Queensland have gone through the roof. That's unsustainable. We'll see some correction there, I think, in the medium term. But you're right. The US story on property is quite unique. Fixed rates and other bits and pieces, and also link it back into how people actually fund their retirement in the US as well, because that's another factor in the mix.
Indeed. Okay, just this is the last chart for the day, and then we can call it. And basically what we've got here is, on the left is the Atlanta Fed wages growth tracker. which has stopped falling, which is positive for American workers. It's stopped falling in the low fives. I believe it's 5.2%, which is something. I wish our wages could go into to over 6% and then stop falling around 5. That would be wonderful. But it is what it is. And on the right here, we've got US wages growth minus US CPI rental growth. So generally speaking, the spread, at least over the last decade, excluding the pandemic, has actually been in favor of rental growth outstripping wages growth. And even if we do see a return to sort of a mid-2000s-esque set of circumstances where rental growth is about 1% below wages growth, that suggests that rental growth, even if wages come down to, say, let's call it 4%, that puts rental growth at 3%, or maybe a tad higher, depending on exactly how it all ends up working out. And that, if rental growth's at 3%, maybe pushing up a little bit more than that at times, that, and considering the fact that that makes up for such a large proportion of the US CPI, that makes it pretty challenging to get it back to 2%. Not as challenging as it perhaps could be in some other nations if they had the same problem, but still not easy.
Interesting. And I was listening to somebody the other day talking about where wages growth has been most pronounced, and it's actually people switching from one to another job. So in other words, you can negotiate a significant wage rise if you can negotiate. But it is interesting to notice that there are quite a few firms now laying people off rather than actually hiring more people. So maybe it's going to be more difficult ahead to be able to switch from job A to job B. So it'll be interesting to see how the wages growth movements in the US, Australia, and the UK all play out ahead. I suspect that with the some of the brakes on the economy, we might see those movements a little bit complex. But I still believe that the rental costs are going to continue to try to push up. So as we discussed at the start, I think looking at that and how much that is sitting as part of the inflation story is going to be a really interesting year to watch this stuff, right? It's going to be absolutely fascinating how all these things come together and drive the trajectory of inflation.
It is, and I think the thing with rents as well in the US in particular is that, and I mean, I guess it's the same in Australia if you really think about it, but it's a story of lags. What we're seeing now is still catch up for 2022 and early 2023. So I think that there is a scenario in which rental inflation does come down, but that is more of an artifact of the fact that the CPI has issues with lag. And if you start to see this re-acceleration of rents, some analysts have said, late 2024, early 2025, re-acceleration of inflation. I think that would really, really complicate things, particularly if it comes at a time when perhaps the economy isn't doing as well as it's doing today.
No, absolutely right. Well, I think the message from the conversation today is that this year is going to be a complex year. There are lots of interactions, lots of cross currents, but the prospect that the markets were banking on, which was an immaculate landing at the 2% target or whatever the target is based on where you look, is complicated by reality. And sometimes
basically
reality gets in the way, and I think that's what we're talking about now. So I think you can expect this coming year to be complex and difficult, and the cross currents are pretty concerning. And I guess, Tarric, we'll pick it up again in a couple of weeks. I'm sure there'll be more things to talk about, because I have to say, every time we have these conversations, it always amazes me how we manage to blot up an hour plus, and we've only just scratched the surface.
Yeah, too right, mate. I mean, it's been 3 weeks since last time, and we couldn't get through everything. No way.
No.
But we promised the viewers that we will give it our level best, and just try and get through as much as we can in a in a factual and, what shall we call it, entertaining way.
Yeah, we hope we are entertaining as well as factual. But the point is, it's data driven. I think that's really important. Tarric, thanks very much for that. Have a great weekend. Look forward to catching up again down the track, and there will be more to talk about.
Oh, there certainly will, mate. I'm looking forward to it.
See you. Take care. Bye bye.
Bye, mate.